Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios here today on Good Friday. Good Friday to everyone. Hope everybody has a great day today. It's beautiful here in Cincinnati. Hopefully, everybody has some fun plans for the weekend as well. Ez, you got anything coming up here? You doing some Easter egg hunting or any of that sort of stuff?
No, my body's barren and we're not producing eggs anymore for the rest of my
That's right.
life. I've hit menopause.
That's right.
There's actually a couple concerts here in Nashville I'm looking forward to going to see, so I'll probably do that.
Very cool. But definitely doing the Easter egg hunting, little kids, and doing a little Easter brunch on Sunday as well. Probably get the picture taken with the Easter bunny, and yeah, we're going to check off all those boxes this week. It's going to be a lot of fun. Hopefully, you guys are enjoying your holiday here today. If you're off work, great day to be outside. I'm looking forward to getting outside right after this podcast, actually. So we'll dive into it. But we got a lot of ground to cover here today. This is an important one. We're going to get right to it here as we have had a lot to discuss over the last 7 weeks. This has actually been the fifth fastest sell-off in the S&P 500 since 1950. So we're going to cover a lot of ground here today, get to a lot of historical data. Most importantly, we're going to provide some actual perspective on this. What's the risk and reward of making any decisions right now? Um, and you picked a good show to tune into here today. So if you're new to the program, welcome. You're in the right place. If you're a longtime subscriber to our show, thank you for your viewership. And please like, share, and subscribe to Shepherd Wealth Management Podcast to friends, family members, and coworkers. It's a great gift to have because we provide some edge here. The reason why we're doing this show, the reason why we keep doing this show, is because one, we get a lot of great feedback from this, and two, most importantly, we are attempting to solve the biggest problem that individual investors have. Listening to the best investor of all time, Warren Buffett, as to why individual investors do not achieve the results they're looking for consistently over time is because they have no control over their emotions, or what he would call temperament. And how we get control over our emotions and temperament here for our clients at Shepherd Wealth Management is to acknowledge whatever the concern is that the news wants to bring to our attention, but also to look back in history, because the market is made up of human beings throughout all of history, going all the way back to the 1800s, where we, believe it or not, still have market data, all the way through today. There's been all kinds of different geopolitical risk, different presidents, different interest rate environments, different concerns, different things that make you happy. But the thread line through all of those periods of time in the stock market is human beings. And I think nobody would argue the fact that humans haven't changed all that much in a couple thousand years. So their behavior, in other words, is very predictable. Now, for the compliance hawks out there, past performance is no guarantee of future results, and investing does involve risk, including risk of loss. But if you are a long term investor, you would understand that. I think most people understand that if you're looking for a gain, there has to be some risk associated with that. But really, what we're here to do for customers and viewers all around the world is to simply help solve that biggest pain point problem that Buffett described as not being able to control your temperament as the cause of inconsistent and sometimes depressing results. So, what we do is we say, hey, this is what's going on. Here's why it's important for the news to bring this to your attention. But keep in mind, the news is a for profit entity. They understand this topic called behavioral finance probably better than anybody in the course of human history. And all that study simply produces an outcome of, hey, humans feel losses twice as much as they feel good about making a gain, regardless of the amount of money that you've gained. You will feel losses twice as much as you feel good about a gain. That's what behavioral finance, the study of that, helps us understand that human beings are hardwired with a lot of emotions. But two primary drivers when it comes to making investing decisions in a human is fear and greed. And we are more fearful. We feel losses twice as much as we feel good about a gain, which is the reason why the news is generally showing us a scary headline. The reason why they're doing that is because it's engaging us twice as much as it would about a news headline that's happy. So if we're more engaged, in this case, twice as engaged, that's going to keep my eyeballs on your screen longer. That allows for more viewership, which allows for ads to be sold at a higher price. That's how they make their money. I don't have a problem with that. But it gives us an opportunity to solve that biggest pain point because we're all humans. We have these smartphones on us these days. We get information, these headline news, we get faster than ever at any point in time in history of all human history, which means we're going to react to that generally a little faster. And that's what we're going to be talking about here today is what happened, why it happened, but more importantly, what does history have to say about it? And that should give you the perspective that you need to understand the risk and reward of any decision that you're making. In other words, that will shut down the emotional side once you put things in the right context. You can make decisions clearly now. And that's what we're here to provide for clients. So let's dive into it today. Headlines, not fundamentals, are developments that are driving the stock market. And I have some headlines here today, as you know. I get data. We pay for data here at Shepherd Wealth Management from all kinds of places. Some of it comes from, well, places that you guys are probably already getting information from, one of which is Barron's. I am a Barron's subscriber. I've been a subscriber for many years now. I get a weekly newspaper, believe it or not, for all the, by the way, I got a chance to talk to some high school kids, and not only did they not know who Warren Buffett is, about half of them, but you show them something like this, it freaking blows their mind. They're like, what? We got actual paper here showing net asset value of shares and different commodities and their last trading price and all this stuff. No freaking idea. Like all they're knowing is Google and I guess now Chat GPT. So that's a different podcast. But welcome if you're one of those high school students that I got a chance to talk to and you're watching the show. Paper is still okay, but I agree with you. Tech is better. We like tech here too. But anyway, headlines are what driving the market right now. I'm going to prove this to everybody. So I'm going to start with Barron's. And now keep in mind, I get this every week. So this is from April 7th. And then I also have one here a week later for April 14th. And you're going to see some connections here, I think. First headline, this is on page 5. And just so you know, if you don't get the paper like I do from Barron's, the first couple pages are really like an index. Like here's what's in the paper, so on and so forth. So this is really the first headline on the April 7th Barron's. And it says this, quote, Trump can't win this trade war. The stock market is the loser. And he goes on to say Trump called it Liberation Day. Others have dubbed it Ruination Day. We'll just call it the next step on the way to a bear market. Are you freaking kidding me? This was written by Ben Levisan. And I'm going to talk about this in some more detail here, but I want to get to some other headlines. But Trump can't win this trade war. So, first of all, this isn't a trade war. This is definitely something that's being run with in all news outlets. The reason why it's not a trade war is because we've not slapped on those reciprocal tariffs, and you're not seeing other countries outside of China anyway retaliating. And China themselves said this is going nowhere, and we'd like to talk. So I wouldn't call this a trade war, but that's what the news wants to run with. And hey, they're in this business to make a profit, so this will certainly capture your attention and engage you twice as much as it would have been saying, hey, this is a negotiation, not a trade war. I think most people would agree with that. Moving on to the April 14th, so just 1 week later, another headline from Barron's: the U.S. came close to financial disaster, dash, and could again. Tariffs pushed the market for U.S. Treasuries out of investors' comfort zone. The White House was caught off guard. In addition to that, in other headline here, we have something I'm going to get to in a later segment here today, but it's regarding inflation. Never mind CPI, how to track real-time trends. So I'm going to get to that as well. But these documents, not just in Barron's, but across the internet, across pretty much every major news outlet, is talking trade war, and tariffs themselves are going to cause unemployment. They're going to spike inflation. They're going to cause the worst recession that we've ever seen in the human history, even worse than 2008 and 1929 all put together. I'm about to debunk the headline topics that I just talked about. That's Trump can't win this trade war. This is a trade war, not a negotiation, et cetera, et cetera. It's going to spike inflation, cause unemployment, and all these terrible things. Well, last Friday, as we usually do here at Shepherd Wealth Management, we connect with our clients via either a lengthier newsletter or a short blog. Last week, we wrote a short blog. It's 1 page long, back with some data. And last Thursday and Friday was some of the best inflation news that we've received in this country for nearly 2 years. So Thursday, April 10th. Again, I just talked about headlines here right around the same time. So this was April 7th. Terrible headline news here, all backed by uh, a word salad, not any actual hard evidence, which I'm about to give you the hard evidence here in a second. And we just talked about another one a week later that's showing the similar sort of headlines. So Thursday, April 10th, we got headline CPI news. So this is the headline inflation number that we've all been watching for over 2 years now. But it started with jobless claims. So the first thing is inflation is going to cause unemployment. The Fed chairman himself said this. I'm about to quote him here in just a little bit. So keep all this in mind before I get to some of these direct quotes. But jobless claims last Thursday came in line as expected, 223,000. That's exactly what Wall Street was looking for. That is a good report. You did not see an increase in jobless claims. And by the way, this is the most important data point. If you're going to throw around the R word recession, it's going to start with layoffs. So if you're seeing massive layoffs from corporate America, I would agree with you that that is a very scary thing and something that I would be highly alert for because if consumers don't have a job, well, they can't consume. If they can't consume, then corporate earnings will go down. Unemployment certainly would go up, and all of that leads to recession. But that's not what you're going to find here in this data. So again, jobless claims came in line, really good. CPI month over month. So headline inflation, the market was looking for positive 0.1% month over month. It came in negative 0.1% month over month. So it was over 100% better, meaning lower inflation data than we were expecting. Year over year, headline inflation came in at 2.4%. The market was looking for a 2.6% year over year number. And by the way, last month, the number was 2.8% year over year. So you're seeing headline inflation both month over month and year over year fall substantially. And by the way, the Fed is looking for 2% long run inflation. Well, right now, we're within spitting distance of that at 2.4%. And likely we'll hit that within a month or two. Core CPI. Market was looking for positive 0.2%. Data came in positive 0.1. Again, lower is better here. Lower inflation. Again, beat expectations. Core CPI year over year, 2.8%. Market was looking for 3%. Again, lower is better. Last month, that number came in at 3.1%. Nobody talked about that on Thursday, of course, because the headlines is what driving the market, as we've talked about here. Trump's going to cause uh, the worst recession essentially of all time. The very next day, we get what we call wholesale inflation, in other words, PPI. So the producer price index month over month on Friday, April 11th, the market was looking for positive 0.2%. It came in at negative zero point 0.4, negative zero point 0.4 month over month. You're talking about hundreds of percentage points better data here, lower being better. That's great news. Also, that number was positive 0.1% last month. Let's look at the core. So core wholesale inflation market was looking for positive 0.3% month over month. It came in at positive 0.1% month over month. And oh, by the way, the last report was positive 0.4. So how are you going to get retail inflation, the inflation that consumers feel, that's otherwise known as CPI? How would you possibly get that if the wholesale inflation numbers are falling off a map? It'd be hard to do. But we're going to get to why people feel as though this is not going to be the case here in just a second. Let's look at wholesale inflation year over year. Wholesale inflation, market was looking for positive 3.5%. It came in at positive 3.4%, again, beating expectations. What was the one thing that came out on Friday, April 11th, outside of Thursday's awesome inflation news and Friday's great inflation news? What was the one thing that was viewed as a negative? And here it is. The Consumer Sentiment Survey, which we've talked about many times here, comes out very regularly. Um, Consumers were looking for, well, first of all, last month, the last reading of this, consumers felt kind of okay about overall economy. And by the way, this survey it would sound like this. It would sound like, hey, Ezra, how do you feel about inflation 1 year from now? How do you feel about the economy 1 year from now. And they have a range. And last month it came in at 57, which is kind of okay. Market was looking for 54.6%, and this month's reading it came in much lower than that 50 point. So in this instance, lower is not better. We typically like to see a higher number here, meaning that consumers feel very confident about inflation expectations 1 year from now, feel very confident about the economy 1 year from now, etc. That is the only thing that's come in negative. That consumer sentiment survey certainly fits with all the headlines I'm looking at here, but it's not showing up in any of the hard data at all, right? Hard data would be jobless claims, it would be inflation, it would be corporate earnings, those types of things. And matter of fact, that isn't exactly what the Federal Reserve has been looking at. Those things, inflation reports. They've been looking at corporate earnings. They've been looking at the unemployment rate. Those are the things that they use to make decisions on. However, Fed Chair Powell couldn't help himself and allowing some of his own personal bias get in the way of his actual duties. And I'm looking at, you could pick this from any news outlet, but I think a lot of people are pretty familiar with CNN. So I ran with this one. And the headline is this, and this is as of 5 minutes, or this is on the 16th of April. Headline is this: Fed Chair Powell gives starkest warning yet on potential economic consequences from tariffs. So the first word in there that I would point out is potential economic consequences, but people are certainly going to skip over that. But here's what Fed Chair Powell said at his most recent press conference in front of a bunch of folks in Chicago. Powell said, "quote The level of tariff increases announced so far is significantly larger than anticipated, and that the lingering uncertainty about tariffs could inflict lasting economic damage. With Trump's tariffs putting the economy on a path toward weaker growth, higher unemployment, and faster inflation, all at the same time, the Fed is also facing a situation it hasn't dealt with in about a half a century." All right, well, let's break this thing apart here. Um, First of all, the level of tariff increases announced so far is significantly larger than anticipated. Yeah, if you were to actually have slapped on all of the quote reciprocal tariffs that were paused for 90 days, except for on China and a couple other goods, I would agree with you. In this instance, in its totality, the tariff increases are much lower than anticipated due to the 90-day pause. Now, it is a pause. So I'll grant you that. Lingering uncertainty about tariffs. Yes, that is, in fact, what you're seeing in the consumer surveys, right? We just talked about that. People feel one way or another, depending on your viewpoint, mostly your political viewpoint, on how this is going to play out. But again, it's not showing up in any of the hard data. Trump tariffs putting the economy on a path toward weaker growth. Well, we're not seeing any weaker growth right now. Higher unemployment, you're not seeing any of that, and faster inflation. Matter of fact, inflation is going the exact opposite way, which is what I just described to you. And Powell knows all this, of course. And all at the same time, the Fed is facing a situation it hasn't dealt with in about a half a century. Are you freaking kidding me? Well, what they're referring to there is stagflation, where you have prices going up, inflation rising, and growth slowing. That's what he's saying here. And that is something that has happened in the past. But you're not seeing any of that in any of the hard data that I've just described to you here. Inflation is, in fact, falling. So the Fed's Fed funds rate as of today is at 4.5%. The Fed believes its neutral rate, meaning the rate in which it's not stimulating the economy nor holding it back, is right around 3%. So even though they're expecting higher unemployment, slower growth, and higher inflation, they still have not called off their two interest rate cuts this year. The market's actually pricing in 5 rate cuts from the Fed at 25 basis points apiece. I've said since January of this year that the Fed's going to do 3 rate cuts at 25 basis points a clip. But besides all of that, you can't get to a rate cut, according to the Fed, until we have some more clarity regarding tariffs. That's exactly what Fed Chair Powell said in this press conference. So If this is in fact a negotiation, not a trade war, as the media would want you to believe, and we know the Fed chairman himself and his Fed head members are not involved in any of the trade negotiation, and they shouldn't be. They have a dual mandate from Congress, one of which is maximum employment. We have that 4.2% unemployment rate, and the other is price stability. I would argue that we have that as well, being at 2.4% headline year over year CPI. And the Fed hasn't changed their interest rate policy at all in 2025, meaning they have not done anything with interest rates. That the Fed keeps their rate at 4.5% and inflation falls without doing anything, they are restricting the economy. They're becoming more tight day by day. And if your mandate is maximum employment, and again, that box is checked, and the other is price stability, and I just gave you what the headline inflation number is, and you're still unwilling to cut or consider cutting. And why is that? Because, in your words, the uncertainty of tariffs and what you're calling is going to lead the economy to a path of weaker growth, higher unemployment, and faster inflation. Well, let me tell you something, Mr. Chairman. You are assessing this much like the overall market, or the market's taking the cues from you, which is usually the case. And here's what the market's saying with what Fed Chair Powell is saying is that this new tariff world we're living in at the moment, the Fed and neither can the market price in, well, this product probably won't be tariffed at this rate, but these other things might, and this country might have they can't do any of that. So what they do is this, is the market's like, okay, well, since the Fed can't figure this out, we can't figure this out. So we're just going to pretend like this new reciprocal tariff policy that was announced on April 2nd, that is now the new 11th commandment. And everything is going to be like this from now on for always. So we got to price it all in across every asset class and every product and service across every. That's what it did. And that's why you're seeing the fifth fastest sell off in the history of the S&P 500. We all know that that's not the case at this particular point in time. This is strictly a negotiation. It's been discussed over and over again. This is not a war that we're looking to get into with other countries, simply just trying to make it a more fair environment in which for our companies to do business with citizens in other countries all over the world. That's what this is about. But the Fed chairman's own bias is filtering right through these news headlines and spilling into investors' hands, causing panic selling, which is exactly what we're seeing here. But uncomfortable about this new way about trying to do trade negotiations, essentially. And the Fed is basically saying that this is going to happen and this is going to cause weaker growth, higher unemployment rate, and faster inflation. No hell in the wonder the news took that and ran with it, because your sole job is to provide price stability, which is inflation. Again, we're freaking right there, what the Fed's looking for, and maximum employment. And you're going to do this. You're going to throw out stagflation on a topic that you're not even in the room to discuss or have any idea of what may happen, when, and how. You could have just simply said, hey, the news here in the economy has been stellar. Unemployment rate not moving. If anything's getting better, and inflation's, it's just kind of non-existent. Corporate earnings have been phenomenal. And yeah, we don't really know what the impact of this is. So could it cause some problems? Maybe, but we're just not sure. I mean, the last time that we went through this in the first administration's turn at doing something different with trade worked out. So we're going to be optimistic that this is going to work out again, but we don't know for sure. So we're going to hold our water. But outside of this, looks like a pretty good environment for us to begin to reduce our rate policy. And I mean, that's really what the honest answer is. What he said here is that, hey, we're uncertain about tariffs, but we're just going to go ahead and say it's going to cause weaker growth, higher unemployment, faster inflation, even though we have no freaking idea if any of that's true, because it wasn't true the first time that they tried to do any of this stuff. But what that also means, the inverse of that, this will happen one day. I don't know what day it's going to happen or how soon or any of that. We're going to wake up and hear about these negotiations and their outcome, saying, hey, these countries and the United States have dropped their tariffs to zero, or a flat 5% or 10%, whatever it is, much, much lower than what those reciprocal tariffs were announced on April 2nd. That's what you're going to see. And then what you're going to experience is this. Well, I felt this way about it before I knew what the outcome was. Now that I know what the outcome is, let me look around. Well, unemployment is still around 4%. Corporate earnings have still been amazing. Now the CEOs can give some clarity with their guidance going forward now that this is behind us. Um, let's see, inflation's still falling, and we've got some tax cuts coming, deregulation happening. Oh, that's right. The trade tariff thing wasn't a war; it was really a negotiation, and we've actually got a much better deal for our businesses here in the United States to do business with other countries and their citizens all over the world. That's a pretty good backdrop to want to be invested, and it just removed the Fed's number one reason why they don't want to actually have a true conversation with the American public about what is actually with the hard data and what they should actually be doing about it, because it removes their barrier to want to cut rates immediately. Now you have no leg to stand on whatsoever because inflation's falling off a cliff and unemployment's at 4%. Sounds like a pretty good backdrop to me to want to be investing. And damn sure doesn't sound like a weaker economy, doesn't sound like unemployment, doesn't sound like faster inflation, and sure as hell won't lead to something that the news wants to maybe even see happen just because it would help out with their viewership and their ratings. I mean, if you get a full blown recession, of course, they're not going to waste a great pandemic or anything like that. I mean, that's what they thrive on, right? So that's the inflation data, and that's how Powell's interpretation of all that data came out. And the reality is his interpretation of that was more of his own personal bias as opposed to doing the professional thing, being a pro and doing your job correctly and assessing the situation through the data lens as opposed to the lens that you have bias through. Which I give some grace to. We're humans. Every human being has a bias, and unfortunately, I don't believe that people that are put in that kind of position that affects all Americans across every income bracket and every industry, not just here in the United States, but around the world. I would like you to be a little bit more professional about how you go approaching um, this topic, as well as the actual people watching. And there's a lot of people watching and reacting to your comments because you are in that position, and unfortunately, your bias has clouded your duties, in my view. But that'll quickly change, as I mentioned. Now, I did want to get to this because I thought it was one good thing in the Barron's articles here that I've been going through that have really been driving a lot of the rhetoric on Wall Street and actions by investors. There's something called the economy column here in Barron's, and the headline is this: "Never mind CPI, how to track real time trends." So this is outside of the typical inflation that we talk about on this program, as well as what the Fed's looking at. So I wanted to get into some of this with our audience as well. So one barometer for real time spending can be found in weekly expenditures at restaurants. Through week end February, restaurant spending was up 3.5% year over year as of March, according to Bloomberg data from credit and debit card transactions. And the biggest driver of consumer spending is employment, as I've mentioned here. Major shifts in the number of Americans filing for unemployment benefits could signal deteriorating labor markets, but that's not what you're seeing right now. Through the first week of April, weekly growth in Labor Department's initial jobless claim numbers has remained low, as I just mentioned. Another one, weekly attendance at Broadway shows, which typically draw the higher income crowd that accounts for much of aggregate consumer spending, can also help gauge discretionary spending appetite. So far, turnout is still on the upswing as of April 6th, according to data from industry group, the Broadway League. So there's all kinds of different ways that we can go about viewing the consumer, their appetite to spend, et cetera, et cetera. The bottom line is this: if they don't have a job, they're not going to spend. And if they don't spend, that's going to hurt corporate profits. And when corporations are having a hard time making money, they will lay off people. And the cycle is Very vicious. It continues all the way up until the point where the Fed has to say, you know what, this is too much. This is part of our mandate. Unemployment is way too high. Now we have to step in and cut interest rates to stave off, hopefully things like recession. None of this is showing up in any of the data. I don't care where you look. I've looked at all of it. I've had 7 weeks to sit here and look at the history of all of this stuff. And none of it, nowhere, is screaming recession, stagflation, none of this shit. It's absolutely asinine. And a matter of fact, it's not even journalism at this point. This is criminal. There's a lot of people that watch CNBC and CNN and all of these programs. All of them are doing a really good job of keeping their ratings up because of this quote unquote headline risk, even though it's showing up nowhere in the data, not anywhere at all. So here's the reality of the situation. Once you put this into the right context, you can start to make some pretty good decisions. The news didn't talk about any of that inflation data. They reported it at 8:30 in the morning on CNBC. Every time there's any sort of macroeconomic data, you can count on it being there at 8:30 in the morning all the damn time. Thursday and Friday, April 10th, 11th, didn't talk about. Reported it begrudgingly from a lot of them. They couldn't believe it. Like, oh, damn, I can't believe that this data is that good. But it's still data. I was sitting there with my wife, Nicole, as we're sitting there having coffee. I'm like, hey, this data is going to come out good. But I guarantee you, the first thing that's going to come out of Steve Leeson's mouth on CNBC is, oh, this is stale data. This is, last month's. Even though we've been looking at the same damn data every month, month after month for 2 years. And that wasn't a problem then over any of those periods of time. It wasn't stale data. It was important data that the Fed was going to use to make decisions. And we're trying to game out what the Fed's going to do with this data, right? That's what we've been doing on this show for over 2 years. I called that one right. They wouldn't even talk about any of this news. But here's what the other side of this looks like. All right. So since 1950, as I mentioned, we just saw the fifth fastest decline in the S&P 500. But since 1950, during that 7-week sell-off, we've had 2 consecutive days where the S&P 500 was down more than 4.5% in back-to-back days. That's only happened 4 times since 1950. So what were the 4 instances? Well, one was Black Monday, October 19th of 1987. That was a really bad day. Markets were down over 20% in one day. A lot of hard data reasons for that, by the way, which we can talk about, but not for today. 2 times in 2008, and again 2008 for the whole year. That was the worst 1-year result in the S&P 500 since 1929, which was the Great Depression. That's the only thing that you can compare 2008 to. That's how bad that was. But that happened twice in 2008, where we had back-to-back days of greater than 4.5% negative results in the S&P. And the fourth one was COVID, March of 2020. And this is the fifth time that this has happened. So what happened the other 4 times? Well, 12 months later, 4 out of 4 times, the S&P 500 was positive. So it was a 100% win ratio. So in other words, if you're a long-term growth investor, if you're buying the dip and you're looking 12 months out, there is no risk historically, right? Well, what's the reward for taking on that risk of quote buying the dip? Well, the average result of all 4 instances 12 months later, the S&P is up 34%. So if I'm a long-term growth investor and we experience the 5th fastest drop in the S&P and only 4 other times in history where we've had back-to-back days of minus 4.5% or worse in the S&P, and I'm a long-term investor looking for growth, if I buy the dip, well, what's the risk and reward? Well, historically, looking 12 months out, there is no risk, 100% win ratio in the S&P. And the reward for doing that, you average 34%, which is a much better result than I think anybody, including us here at Shepherd Wealth Management, would expect the S&P to do over the next 12 months. So the question is, what are we buying? Well, we came into this year with some broad-based diversification, which Warren Buffett would say diversification is the death of performance. And it's for those who don't know what we're doing. And he's 100% right. I can prove that to you with just simple math. The way that you calculate performance is you take the weighting of your position one, multiply that by the performance of that position. You get a number. You take that number and you add it with the next weighting and performance, so on and so forth. So if you have 1,000 positions, like a lot of investors do because they're diversifying across 10 different mutual funds, and every one of those mutual funds has 300 positions inside of them. Well, one of those positions is likely Nvidia, and Nvidia is up about 400 or 500% over the last 3+ years. And if you have 1,000 holdings and one of them is Nvidia, and you got a quarter of 1% of your money or half of 1% of your money in a name like that, and it goes up 400% over the course of a few years, you're hardly going to feel that at all. It's going to be almost not noticeable. But if you got 5, 10% of your money in something like that, you're damn sure going to feel that. It's going to feel good. No question about it. So diversification is the death of performance, and it is for those who don't know what they're doing. So we came into this year with half positions in individual names. Let's just use tech, because tech's got hit the hardest over the 7 week sell off. So we had half positions in tech. The other portion we wanted in tech, we put it in the queues, spread out that risk across the entire sector. Did that with banks. We did that with industrials. We took half positions in the names. The rest of it went to the index. And then we added a 15% weighting for corporate bonds for clients coming into this year. January 1st through February 19th, we're up about 8%. Market's up about 4.5. Clients are loving it. We're doing this with broad based diversification. I am in no hurry to make a change. February 20th comes around. All of the hard data that we just talked about is still looking at us right in the face, but the soft data, the headline risk, was taking over everybody's decision making. And to me, I'm looking at it, I'm like, well, the hard data is not matching with the soft data. So I can't get fearful along with everybody else. Matter of fact, Warren Buffett said, let's be greedy as others are fearful, and let's be fearful when others are greedy. So I want to be greedy because the hard data is not matching the soft data. And historically, now that I've gotten this in the right context, historically, if I'm a long term growth investor looking out 12 months, I don't see any risk by buying this dip. And the reward for doing that is freaking awesome. So, what do I want to own? Well, I'm going to take the diversified corporate bond ETF, given that that's likely going to fluctuate the least during a market sell off, sell that, spread that out across tech, finance, industrial names. Market keeps selling off. Industrial, the Dow Jones is a decent proxy for industrial performance. That was only off about a percent and a half at the early sell-off, whereas the S&P and the Nasdaq were down around 10%. Industrials didn't get hit right away. We sold the industrial ETF, used that to do what? Buy tech and banks. I want to come back to industrials, and I'll show you how we're going to do that in a second. Volatility continued. We've already gotten rid of our corporate bond ETF. We got rid of the industrial one. Now I'm selling the XLF, the bank ETF. I'm using all of that money to buy bank names. Market keeps selling off. Last thing, triple Qs, sold that. Use all of that money to pile into the individual tech names that we really wanted to own. I'm not going to give you the tech names because you guys aren't clients, and this is not a podcast of me giving you guidance on how to build a asset allocated portfolio with individual names. If you want that, hit me up at 513-630-2664. We'll set up a meeting to understand your specific needs and situation and come up with something designed for you and your goals. But that's what we did for the long-term growth investor here in general at Shepherd Wealth Management. And we're very excited that we were able to pick up some of the best names in these sectors at prices that are half of what they were before the sell-off began February 20th. So how will we get back to industrials when we are right and proven right with performance, specifically out of banks and tech? We will take profits from that, not eliminating those, but taking profits from that while we're still staying overweight the sectors. I'm going to use that money to buy industrials for our customers. And industrials will come around. Of course, all the policies that are coming out of the White House right now are pointing directly at the manufacturing sector, the industrial sector of the economy. And it probably will take a little bit of time for the true growth to come from that. So I don't need to be in a substantial rush. And last but not least, what were the best performing sectors during the first Trump administration? Well, first of all, that administration's policies, all the things that they did, whether you liked them or didn't like them, it led to the S&P 500 up 88% over the 4 years. And the four best performing sectors were tech. Tech was up about 140%. Consumer discretionary was a close second. Industrials and financials. In this instance, we believe Financials will probably be the second best performer this time because the Fed is going to have to cut rates to get to their neutral rate. Whereas in the first administration, rates were already really low. Fed was trying to increase rates to get to neutral. Therefore, just because they're cutting rates will provide even more of a tailwind to the financial sector. So that's exactly what we're doing here for customers. It's essentially the opposite, the contrarian view, if you will, from everything that you're seeing in headlines. But it's not just because we want to be different or contrarian, even though that's really hip and cool. This is all backed up with actual hard data showing why consumers are reacting the way that they are is not based on the hard data. It's very obvious of where it's coming from. It's your emotions. It's showing up in surveys. And it's no hell in the wonder why it's showing up in your emotions because the news is doing a great job of taking the Fed's cues and running with these terrible headlines based on their bias, not any actual hard data. And then when you look at history to help really put things in the right context and make clear decisions on all other instances, all four of those other instances I just described, there was hard data evidence as to why the market sold off. In this instance, it's not. So, in other words, there's no real big thing to solve. We just got to get past the headline news, and that can be done in a tweet. Last Wednesday, you saw the S&P 500 up 9.5% in one day, really in one afternoon, based on one headline. Now, our clients thankfully were up almost 15% that day. That was a really cool day to just to sit there and watch. But that was after dealing with a hell of a lot of stress for no reason other than that consumers are fearful. I get that. We're humans. There's nothing wrong with feeling your emotions, but it needs to be based on some sort of evidence to allow you to feel that way other than what the headlines are. And I think we've done a really good job here in this particular podcast of making that connection between the hard data not matching with soft data. The soft data is a correlation with what the Fed chair is saying and what the news is printing. And all of that is based on bias, not actual data, as we just described. And historically, these other instances where markets sold off similarly, there was all kinds of hard data evidence as to why the market should have been selling off the way that it is. In this instance, it's not. And when we look forward over the next 12 months, things look really, really good. Again, until that hard data matches up with any of the soft data, there's not much to be fearful of other than your own emotions dictating the decisions that you may be making. And if that's a struggle for you, you are definitely on the right podcast here. Please like, share, and subscribe it. If you'd like some more clarity on how we can help you specifically, or if there's questions that you may have, please leave those questions right here on our YouTube page. You can also email me, go to shepherdwm.com. You'll find all the information about us, my background, experience, and how to get a hold of me. So we look forward to continuing to do this. But that's all for today, folks. I think we've done a great job here in this particular podcast. And we'll keep doing this about every 2 weeks. So look forward to doing this again, probably early May. And of course, so we'll address any of the comments that we get from today's particular podcast. So hope you guys have a great Easter weekend. Enjoy the weather. And God bless you. Have a great rest of your weekend. And we'll see you next time. Take care.